G'day guys, Ben and Simon here from Pumped on Property. Now in today's video, we're going to give you a nice short, sharp update on the Aussie housing market / economy. Over the last few weeks, we've been getting all sorts of different ideas, opinions and data points from the likes of CoreLogic, SQM, Heron Todd White, the great Phil Anderson, as well as Westpac Bank, CBA Bank and a bunch of others. So this is going to be jam-packed, a really nice little update for the next year or so. Again, we can never predict the future, but we can use some of these data points to start to see what's coming next.
I've absolutely loved being subscribed to CoreLogic recently. I'm basically just getting one email per week of
epic info, eh?
Yeah, some ridiculously good information. The best thing with CoreLogic is they've got such a big market share and it's just really data-backed information. So I've got the yearly change in dwelling values here and also the quarterly change in dwelling values in Sydney, Melbourne and Brisbane. So for the quarterly change in Brisbane up until October, nothing, which is really good news. It's the first time since coronavirus started that it's actually been at zero, which is nice. Sydney still losing a little bit over the quarter, coming back by a negative 1.7%, still positive than previous quarters since coronavirus started. And Melbourne being the capital city in Australia that's lost the most value over the most recent quarter of negative 3.3%. So nothing new there necessarily, but still a good update. But then what I thought was super interesting was the yearly change.
The yearly changes, man. Like with the way the media's been, you would have expected property prices to drop 100% straight up. It's been so negative.
It's been so negative. And at the start they were saying 30% drop, but listen to this, guys. So Sydney is up 7.7% on the year. Melbourne's still up 3.1% and Brisbane's up 3.8% year on year.
You know,
ridiculous.
It's not where we thought we'd be, or it's not where some people thought we'd be, but it's interesting to see that. It'll be interesting once we get the whole 12 months of data, because obviously the virus only really started to affect the Australian economy from March. So let's see what happens by next March. But you know, for Brisbane, that's cheaper than it was 13 years ago. Perth, it's cheaper than it was 14 years ago, according to CoreLogic. You know, all things considered, I'm just proud to be an Australian at the moment.
No doubt about it.
While the government's getting in massive debt and we will have to repay that in the future, it's cool to see that, you know, we've been able to maintain some healthiness in parts of Australia at the moment.
Yeah, for sure. Something that I thought was interesting, because we've been buying heaps of properties recently and it started to feel a lot hotter in the market, and we've been competing with lots of owner occupiers, and this little data piece actually tells us that that's exactly the case. So over the last 16 years, there is the lowest percentage of investors in the market right now in Australia, with only 23.5% of house purchases going to investors at the moment.
Yeah, which we've been feeling like we've been competing with emotional people, and then it's nice to see that the data confirm that.
Yeah, exactly. And the last really cool one from CoreLogic is they kind of did a bit of a breakdown on the impact of the international immigrants. And a lot of people think this is going to dramatically affect the property market, but CoreLogic believe that it's mostly going to be concentrated in two markets, being Sydney and Melbourne, because they have the lion's share of the international immigrants. But they also say that it's going to affect the rental market more than the housing market, because most immigrants, when they come to Australia, they don't just buy a house straight away. They end up renting, and they typically rent on those inner city apartments and things like this. So really interesting to see there, and that they're starting to see really tight vacancy rates, which we'll get into in those outer suburban areas.
Yeah, so, you know, what's interesting to look at is the longer term position in history. And during the GFC, when things got really prickly from a economic impact perspective in Australia, they just opened the floodgates, and in those couple of years allowed 450 and 500,000 immigrants into the country, which massively helped. We haven't had that ability to do this time, but I can guarantee as soon as we're allowed to start bringing people, the floodgates are going to open and we're going to bring a bunch of people in to, one, support the economy, to massively reduce the vacancy rates in Sydney and Melbourne again. So that's cool. Obviously the budget has just come out as well from the Australian government. Obviously the tax cuts, the businesses and individuals are going to have a massive down the line impact. The other big thing that they've done, which will have a huge impact on capital gains within 5 to 7 years from today, is reducing that interest rate to the point where it is at the moment. And it looks like the Reserve Bank is calling for another small reduction in November. But what I've read in the past from, I think it was Catherine Cashmore or it was CoreLogic, was that for every 1% that the interest rate drops for a prolonged period of time, we get a down the line impact of a 15% increase in house prices. So we've seen that come down from almost 6% back in before the GFC to literally 2 to 3% now. And we will have a knock-on effect as a result of that cheap money. The government's also bringing on massive infrastructure, which is perfect for this stage of the cycle and will help us get jobs back and the economy going again. And obviously the new round of helicopter money coming out to those least affected and most likely to go and spend. So what's happened all the way through this virus is people have saved a shitload of cash. A lot of people that might have been earning $200 to $300 a week have also been earning $700 a week on JobKeeper or $550 to $600 a week on JobSeeker. A lot of people have been stacking cash, and once sentiment shifts and confidence comes back and things start to feel like normal, all of that money is going to flood in. A lot of it will go back to the government through taxes, which will be the way they collect it back.
I was talking to a future client a couple of days ago who's a huge subscriber to Phil Anderson, and we were talking about all this helicopter money that's being created globally, because it isn't just Australia that this is happening, it's obviously all over the world. And there's somewhere between $6 and $12 trillion that have been created globally, and it's got to go somewhere. You know, that money has been created, and it has to end up somewhere. And
I know where it's going to end up. It's going to end up in land prices globally and stock markets globally. Long term, it's just where it sits before it gets there is like
interesting,
right.
But just big dollars, right?
Big dollars. The other update we had was from SQM Research, which again, like CoreLogic's, absolutely gold to follow. Now, we've been watching the vacancy rates throughout the virus. At the start of the virus, they spiked, and now they've been progressively coming down. So nationally, we're sitting at 2%. Some markets are sitting really, really low, like Brisbane, I think Perth, Canberra, Adelaide. Other markets like Sydney and Melbourne are quite high, above 3%. What we've noticed from looking at specific suburbs in Brisbane, and it would be the same with Sydney, Melbourne and everywhere else, some suburbs are so chronically undersupplied at the moment. It's crazy. In fact, in the last month, we've seen vacancy rates almost halve across every suburb we buy. But I'm assuming the opposite is true in some suburbs in Brisbane, Sydney and Melbourne. They've gone up as well.
Yeah, of course. But those outer suburban areas seem to be super hot right now in Brisbane.
Cool as. So what did Westpac have to say? Because that was crazy in the Australian Financial Review.
Absolutely loved it. So we were sent this from another one of our clients, absolute
Matty.
champion. Cheers, Matt. Keep sending us through. Send us your login details as well. But Westpac has come out with their forecasts for the Australian property market over the next 3 years. And they came out saying that they believe Brisbane has the potential to increase by 20% between now and 2023, which is the top performing market in Australia, according to them.
They're also saying like 14% in Sydney, which seems like really high to me. And I didn't really look too much into the other markets because right now they're not on my personal radar.
No, but it is really positive. And a lot of these guys are coming out and saying that they believe from the end of this financial year, so from July next year, they really start to see they're expecting to see an improvement in the economy.
Yeah, and you can start to see that. Like you can see the Australian government publishing unemployment figures across different categories. That's slowly coming down. Hopefully those numbers aren't too cooked. You can start to see they're obviously making money cheaper. They're making money easier. They're spending money on jobs and infrastructure. Like all of those things, especially once we find a global cure to this virus, hopefully sooner rather than later, will start to have an effect. But they don't happen overnight. It takes years for that, money and those processes that trickle through.
It'll be interesting. Now, what's our man Phil been saying?
Phil, loving the updates all the way through the virus.
Thank you, Phil.
Super excited as well. Like Phil and I were catching up a couple of weeks back or a month ago, and we're going to start producing content together as well, which is epic.
Can't wait.
Just nice to get that different perspective. Phil started by saying that the main lesson that he learned from studying 250 years worth of history in America is we actually don't learn from that history. And he said that's absolutely true right now. And what he's referring to specifically is that in 2018, basically Trump, as one of his first things as a property man at the top, went on to, there was an act called the Dodd-Frank Act that Obama put in place to protect the US after the GFC from their own banking system so that they wouldn't go through another, GFC, effectively tightening the screws and making it a lot more balanced. In 2018, he completely cut all of those changes so they can pretty much do whatever they want to do again over there. You might have seen the Treasurer in Australia, big article in the papers recently, last couple of weeks, basically said that his main intention at the moment is to completely axe all of the responsible banking laws put in place, not just throughout the Royal Banking Commission, but after the GFC, to protect Australians from themselves in the future and to protect us from the banking industry. So that is super common in the second half of the cycle, especially after a mid-cycle slowdown. But it's really interesting to see, according to Phil, history repeating itself. What he sees coming next, and he's been saying this for the last year, was this year would be the mid-cycle slowdown, potentially half to all of next year as well. And then from there, and we're already seeing it now, cheap money, easy money, and that's what the Treasurer is talking about, making it easier for us to access finance, as well as massive, lavish government infrastructure spending. And those are the three things that get us out of the mid-cycle, and then we start to see confidence come back, easy money, cheap money, lots of jobs, lots of people making short-term money in stocks and property, lots of new wealth, massive speculation leading us into the next cycle. So crazy, bro.
So crazy. What's the best way to make people forget about tough times? It's give them some money.
Good times. Give them some money.
Give them some money.
Giving some confidence, and we forget pretty quickly as humans.
Yeah. We got a bit of a short-term update from HTW, their most recent monthly review of the entire Australian property market. Lots of movement over the last month in their forecast. There is a lot of markets in Australia that's sort of sitting in the start of recovery right now. Brisbane being one of those markets sitting in the start of recovery. They've also put Sydney and Melbourne in the declining phase of the property cycle there as well. So really exciting to see Brisbane go from where they had it previously, which was approaching the bottom, to now back to the start of the recovery.
We hope you've enjoyed this brief update. For those of you looking to get your teeth stuck into more data, subscribe to Heron Todd White, SQM Research, CoreLogic, Phil Anderson. That is a very helpful piece of information that you receive each month from those different providers. And if you haven't already done so, please give this video a massive thumbs up. Subscribe to our channel for more updates like this. As always, we wish you safety and security through these times. And as always, we hope to look to invest or support you to invest with confidence in the future.